Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Paul, what's up, buddy?
How you doing?
I'm good, man. I'm good. Weather's getting a little better here. Snow's melting. Spending more time outside.
Yeah, the problem with the snow melt, right? It's a mess. The salt. Do you use salt up there and stuff?
Yeah, salt and sand it is. It's
Yeah.
a disaster. So you wash your car and then you drive over a puddle as soon as you exit the car wash.
Right.
Yeah.
Right.
Yeah. But that's why I have unlimited car washes.
Yeah, it's good to keep the salt off that undercarriage.
Yeah, for sure.
It'll eat away at it eventually.
Yep. A lot of rusted cars up here in the north.
Yep.
Yep. Anything new in your life?
Well, I don't know. Well, we bought that land in Tennessee.
Yep.
Just waiting to close sometime next month, I guess. And Tammy picked out the floor plan for the house. So
Oh, nice.
so we're progressing nicely.
So
Yeah.
when does construction start?
March of 24.
Wow. All right.
Yeah,
Lined
so we'll
up
spend
with a July of 24 retirement.
Well, that's when I'll stop working.
Let's be honest, you've already stopped working.
No, I'm actually super productive.
Yeah.
Productive. No, I'll stop working in my job in July 24, and then I'll retire 1 March 25. So
Okay.
there's some leave in there, some skill
Yeah.
bridge, some
Oh yeah.
other
Apprenticeship.
things. Yeah,
You could definitely use an apprenticeship.
gonna go to truck driving school.
Yeah, get your CDL. Got to have a fallback plan, man.
That's right.
Yeah. Well, nice. Good. Well, hey, today I think we decided we're going to talk about some myths. I'm not sure what to call this. It's either whole life insurance myths, whole life insurance objections, ignorant statements made by ignorant people. But we're just going to correct some of this stuff. Like, let's just correct it right now, so that we have somewhere to point people when we get some of these questions in the future. Which a lot of it comes from people who maybe haven't been educated enough. But it's also fodder for financial entertainers who are trying to steer you away from whole life insurance. They repeat some of the exact same claims we're gonna discuss today. So
Yeah, no question. If they're tied to the traditional financial space as a CFP or, well, not really a CFP. My CFP sold me whole life insurance back in the day. So but just, if you're a Wall Street person, and I follow some people on Instagram that, I thought had something half decent to say, but when it comes to whole life insurance, they're like, nope.
really,
And
yeah.
and it's just it's the same old stuff. It's annoying, but it's out there and it's plentiful. So.
Well, hey, I guess not everybody likes guarantees. So, to each his own.
Yeah, to each his own.
All right. Well, let's start with the first one. So this is probably one of the most common one, and the most common ones promoted by financial entertainers is, hey, once I retire, I'm not going to need life insurance. As if your need for permanent life insurance expires the day you retire. I can't even logically draw the connection there, but I guess the assumption is that you built up enough wealth, right, during your working years that even if you graduated the day after you retired, let's say you did this, your wife would be fine because you've built up enough wealth that will pass on to her that she can live out the rest of her days just fine. I think that's the assumption, right?
Sure. Yeah,
Okay.
it is. Yeah.
Well, we dug up some stats. Why don't you read some of these stats to us to maybe combat the assumption? And we don't deal in assumptions in this business. We deal in facts and reality. So here's what we found.
Yeah. And this is fairly alarming. And once we tie it all together after item 2 here, so Dave pulled some some numbers of the average retirement savings amount. And our assumption is that we're talking about what's in IRAs and 401ks, because that's where most Americans nowadays are putting their money for, quote, retirement, right?
Right.
So the average for a 65 to 74-year-old was $426,000, which on the surface, right, seems like, hey, that's a lot of money. The median, though, right? It's funny, Anthony's learning this in math right now, is $134K.
Yeah, so that's the person that's right smack dab in the middle. So half
That's
the people
right.
are below that, half the people are above that.
So when we talk about rates of return in past episodes, Dave, we say that really the average rate of return doesn't matter, the actual. And it's the same thing for this. I think the median is more of a better snapshot, because the average number is really, there's some wealthy people out there,
Sure.
or people that are just pinch pennies or whatever, and they're kind of almost outliers when you compare the middle of the road guy, which I think is likely a more accurate snapshot of where people are at.
I'd say so too, because that just means that 50% of Americans have 134,000 or less in retirement savings at retirement age 65 to 74. Now, this came from a 2019 survey of consumer finances. That's where you can find these stats. I found it on NerdWallet. They quoted that survey as the results to this. But so that would be, and I think that's individual savings. I don't know that that's household savings. So,
Sure.
Yeah, for all families. It's families. It's not even individual. It's families.
Yeah, well, I would say too, when you look at the ages in that year 2019, and those were largely single family income homes. People
True.
from our folks' generation that were baby boomers, born in the late 40s, early 50s, into the early through the 50s to the early 60s. So in a lot of cases, it was mainly the dad, if he was around, laboring and keeping the family fed and housed and clothed and whatever.
Yeah.
So yeah, and then maybe mom went back to work after the kids were back in school or out of the house, and that was kind of typical of my household. So
Yeah, that makes sense. But now here's another stat we pulled up. So you just told the numbers for ages 65 to 74, but what about age 75 and older? The median drops from $134,000 to $83,000. So they burned through in 10 years. A 65-year-old who started with $134,000 burned through 1/3 of their retirement nest egg in their first 10 years. And they probably haven't even entered the stage of life where medical expenses are going to be the highest, I would assume.
no question. In fact,
Right.
I had the long-term care discussion with somebody today.
Yeah.
For his parents, who are in their probably their late 70s, and right, that's it's almost like the future's unknown, right? We have no idea, and it's almost never discussed by these people. What do you do? What do you do for medical expenses? Is that factored into your, hey, you're going to average, or 12% in your mutual fund over 40 years? Does that get factored in when the ever rising cost of medical care in nursing homes or specialty care or whatever it is, stuff that's just not covered under any Medicare plan? Like my grandmother gets these eye injections for cataracts, I think, or something, every month, and they're kind of spendy. They're not covered by anything, and they're over the counter, and they're pricey.
Yeah. And you're not going to get the state to get to supply all of that for you until you've spent down all your assets to begin with.
Yeah, we had that discussion too. They're going to burn through everything first, aren't they?
Yeah. And then the state will start covering your bills. But
Right.
you basically have to be, I don't know, close to poverty level.
You have to be destitute, pretty much.
Yeah, destitute before that kicks in. So
Right.
in either case, it's kind of a scary statistic, man, just seeing that. I mean, so many people plan, like Earl Nightingale's The Strangest Secret. He starts out saying, out of 100 men or 100 people, every one of them intends to do well. But by the time they're 65, only 5% of them are financially free. And the rest of them are essentially broke. And
Yeah.
to me, $134,000 in retirement at age 65 you're broke.
Yep.
You really are. No two ways around it.
Yep. Unless you're one of those lucky people that has some sort of government pension, not Social Security, I mean something else like military pension, or
Right.
maybe you have
Sure.
those old corporate pensions or something that still exists, maybe. But
Yeah, that helps. And some of those baby boomers absolutely do.
they do.
But that's certainly gone by the wayside for most people. So, yeah. So the whole myth or objection that I won't need life insurance once I retire, I hope you do better than the average person. I hope you do better than the median. But even if you do average, you're still looking at just 426,000.
Yep. And Dave, I want to wrap this up for some people, because they're like, all right, what's the connection? Well, the connection is, Dave and I, by the time we're the ages that we've kind of listed here, 65 to 74, we've been paying premium for 30, 40, 50 years of our life. And what a lot of people don't realize is that we'll be able to take passive income off of our policy. And we've touched upon this in other episodes, but you'll be able to take passive income to supplement whatever else you have going on. Maybe some of that supplemental income off a policy can pay for some of this care that you might need. And maybe it's not going to count against you.
Absolutely. It'll be an income producing asset, because by that time you had the policy for 30 or 40 years. Every dollar I pay in premium is going to create potentially $3, $4, $5
Sure.
in cash value that I have access to, tax free during retirement. Yep.
That's right. And these policies that we have, they have some things. They're not long-term care riders necessarily. Some companies do have those things, but they have other types of riders where you can access a portion of the death benefit to pay for either terminal illness or even an injury that you might have had that prevents you from laboring or whatever. So those things exist as well, and I guess those shouldn't be ignored either. Those are very helpful.
Yeah. So and not for nothing that it's a way to turn $1. If you can receive $1 tax free in retirement, that's essentially like getting $1.40.
Yeah.
So
Yeah,
I mean, you could either have 70 cents. You put $1 in, you can have 70 cents back, or you can have $1.40 back. That's 100% gain.
It's quite different, isn't it?
Yeah, quite a bit different when you factor in the taxes. So
Yep. Tax-free income in retirement as well. Amazing.
Yeah, very. So, all right. We spent a lot of time on that first one, so we got 6 more we want to get through. So the next one, whole life is too expensive. I'm going to buy term and invest the difference. So the first thing I would ask is, are you investing the difference?
Yeah, you're probably going to spend it. Maybe some people are going to.
Maybe, but the fact they probably don't know what the difference is because they've never actually worked with somebody to run a whole life scenario to begin with. So how do you know what the difference is? Anyway, kind of one of the dumbest phrases I've ever heard because people don't actually investigate it and think about what it's actually saying.
Yeah, that was a clever slogan though that was developed by. It wasn't E.F. Hutton or other. It was someone like that though back whenever.
Very clever. Yep.
Very clever, and made that dude a lot of money and continues to make people a lot of money peddling term products. And
makes life insurance companies a lot of money.
It does. Actuarially, it's probably their favorite product, isn't it? Maybe, well, maybe Universal Life is. I don't know. But it's definitely those two products, right?
Yeah. Yeah. So this kind of goes hand in hand with like, oh, it's too expensive. It's only for rich people. So sometimes we get that, people are like,
sure.
Oh, this, or you read really in-depth articles about infinite banking or cash value, dividend paying whole life insurance. And the conclusion of the author, who's an expert, they don't have a policy. They didn't talk to anybody in the article who actually knows how to design these policies. They've only talked to financial planners. Their conclusion is that, yeah, this is something that could work, but only if you're really rich. And that's nothing could be farther from the truth, right? How many of our clients, what percentage of your clients are really rich?
I really don't think any of them are.
Yeah, at this point, I don't think any of mine are real, what I would consider really rich.
I think it depends on how you define really rich.
True.
I think Bill Gates is really rich. I think if you can live without working, you're really rich. And I don't think anyone that I know is in that category yet. But
I mean, if it's like Joe Biden's definition, I think if you make 200,000 a year, you're really rich, right? Then a lot of my clients are really rich then.
Sure. Right.
But that's not rich.
Depends where you live too.
Yeah, true. Yeah.
Around here, that's nothing.
Yeah. So what I like to do in this situation is really I can show people how over their life, if they live to be 85 years old and you're, middle age, you're somewhere 30, 40 years old when you get this policy, it's going to average out and you'll die with millions of dollars worth of death benefit. When you average the cost, the expense that you paid up front, in the first few years before you start, every dollar creates more than $1 in cash value every single year. That expense, that loss of liquidity that you had to sacrifice for the first 3-4 years, maybe, equals about $15 a month over the course of your lifetime. $15 a month to retire with, to die, graduate with millions of life insurance at the age of 85. Yeah.
Do you show people that very often? I remember you showed it to me, several years ago. Once you learned it, and I was like, yeah, that makes perfect sense, and it's interesting. But I haven't found myself having to show people that because I think we get better educated people as far as IBC. They're coming to us for IBC, but it's a valid point, and it's true. So what Dave is saying, folks, is that you might have heard some people say, well, term insurance is actually more expensive than whole life.
Yeah, as far as what you get back.
Right.
Yeah.
We talked about term insurance pays out, somewhere around 1%, 2% of the time, maybe, meaning you have to die young or die during that term. Meaning
1% to 2% of the time, term insurance is less expensive than whole life.
Correct. Yeah. But the obviously the 98% or better, it's not, because it ends up being just a sunk cost. Maybe your investments did well enough that you can live off them. Well, I'd rather have the guarantee that I know what I'm going to have exactly at what age I'm going to have it, rather than rely on that. So anyway, the whole point is that it's not like they say, because they don't know what they're talking about, or worse, they know what they're talking about and they're lying.
Yeah, that is, Well,
it's one of those two scenarios,
and in either case, it's not somebody I would want to put any faith or confidence in.
No, and I'm sure all these people have angelic intentions, but to say that this, the average individual is buy term and invest in the difference and they don't need whole life insurance, that's a very silly thing to say to me. How can that be the right thing for every person on earth?
Right. One size fits all. Yeah.
It can't be.
So,
except the rich. I forgot about the rich. Yeah, it's not for them. They'll buy whole life, right?
Yeah. So what you're saying, everybody's misunderstanding of whole life insurance
is based, everyone's understanding of whole life insurance is based on somebody else's misunderstanding.
Right. For the person who hasn't done the education themselves to get educated on infinite banking and whole life insurance, you're right. Yep.
Yeah.
Their understanding.
I would plug Ryan's 7-part series, Ryan Griggs' 7-part series on the mechanics of whole life insurance, which is very helpful if you want to kind of really get into the weeds for 7 or 8 hours on the mechanics of whole life insurance.
And you'll know more than 90% of life insurance agents out there.
Yep. And we've plugged that one before, but I've watched it. It's a good one. Yeah. And you will come out, you'll come out knowing more about whole life insurance than probably your financial advisor.
Yep. No, hands down.
Yeah.
Yeah. All right. So next one, Paul, how would you respond to this one? Dividends are just, the IRS says dividends are just a return of premium that I overpaid. It's a return of premium. That's it.
Yeah. That's exactly how they characterize it. Next question. No.
Yeah. Which is great.
Right. It's great. Right. And it's actually cast as a bad characteristic of whole life insurance by certain financial entertainers on television that, they overcharged you for your life insurance, and now they're just giving you back what they overcharged you. Well, if that were true, the policy would never get, other than the guaranteed growth, it would never get bigger. It would never eventually exponentially grow at a rapid rate, as the years tick by and the policy gets really efficient. That would never occur.
Right.
Right? It would never occur. So
that dividend would never outpace the premium I pay every year, which it will.
Oh, by far.
Yeah.
I mean, it'll be many times it could be 5, 6, 7 times depending on when you start the policy. Some of these juvenile clients that I have, and I think I have over 20 now, their policy dividends later in life will be 10 times more
man, yeah,
than their premium. I mean, it's incredible. So imagine, I just think back, I wish I had one of these when I was born, but so yeah, that statement, folks, is just not true. It's a misrepresentation or it's a misunderstanding. It's one of those two.
Well, on its face, it is true. The IRS classifies it as a return of premium, but that is not the full story. That's not the full truth.
That's not the mathematics that's going on behind the scenes.
Yeah. So I guess my question would be like, well, then how could the dividends ever outpace my premium?
Right. That's right.
And see him try to answer that question.
Yeah.
Yeah.
Yep. They don't know what they don't know, and they don't want to know because they're selling something else.
Yeah. All right. Number 4, I have enough assets that I can self-insure. So, okay. That on its face, it does make a lot of sense. Yeah. You have enough assets that if you die, then your spouse, your kids are going to be taken care of because say you have multiple apartment buildings. You have a giant real estate portfolio that's paying that income, every month, every year, that's going to take care of your family. Okay. Granted. So now you're saying your family actually wants to actively take over all of those assets and manage them themselves.
Yeah, they're not liquid, are they?
They're not liquid. You can't spend equity unless you can access it. And they can't probably access that now that you're gone unless they sell them.
And they're probably the result of like many, many, many 1031 exchanges over the last 40 years.
Yeah, probably. So there's going to be a massive tax bill.
I don't know who pays that, but the person at the end, I guess.
Yeah. Yeah, the last one holding the yeah, like musical chairs.
The great grandson's like, what?
You're holding the bag, kid. I'm inheriting all of this, and then taxes are jacked up to the sky by then. So anyway, what we support is the idea that you should really have enough permanent life insurance equal to your assets so that you can spend your retirement years, your passive income years, as Nelson says, paying or living off of those assets. Go ahead, grab the equity in those assets. You worked your butt off all those years accumulating them, and now you're just going to do nothing with it? What did you go build that for? Like, enjoy life. Take that money knowing that when you graduate from this earth, 100% of everything you've taken out is going to be replaced.
Yep. When we know some folks that have, fairly substantial real estate holdings, they're real estate professionals. They do certain things with real estate for a living, that have whole life insurance. They probably need more, but they do have dividend paying whole life, and they have, they pay adequate premium. And, I like the idea of having this insurance in place, Dave, because like you said, it allows me to spend down or enjoy those other assets.
Yeah.
And I'm not worried about, and I'm going to leave a income tax-free legacy. And people say, well, there's estate taxes at the federal level or a certain threshold, and the state level, depending on the state. Tennessee, no inheritance tax.
Nice.
You should move there.
One day.
Soon.
Yep.
Anyway, but there's things you could do with trusts and other things to kind of protect yourself in that sense. But anyway, I completed my thought. Good.
Yeah. No, that's good. So, okay. How about the next one? Hey, Paul, I don't have any kids, so I don't need life insurance, man.
Then why are we talking? Well, this is, I would say, from the conventional point of view, this is what you can find all over the internet. If you're searching for, do I need life insurance or whatever? Well, you only need it if you have kids or whatever. My dad said this to me not a few months ago.
Yeah.
That's how they thought of it. They ignore, and we can thank Nelson for helping us not ignore this fact. They ignore the banking qualities of whole life insurance.
Exactly.
It has more in common with banking than it does insurance, even though there is a death benefit, no question, but the cash value and the death benefit, one is the function of the other, of course. But the banking quality of this product is something, and he says this in the book, right? It should have been taught
Yeah.
over the last 200 years. It should have been taught by the life insurance companies. But as we know, there's home office people that probably don't own home life insurance, even though they might work for one of the most successful mutual life insurance companies in the country.
For sure.
And it boggles the mind. And read that book.
Yeah. Like you said, it gets back to the banking function. Yeah, okay, you don't have any dependents. Guess what? You can leave that death benefit to whomever or whatever you want. Pick a charity. Like, certainly there's something that you have a passion for, some cause that you would like to support. Leave it to that cause. Who cares? This is about the banking function and controlling the banking function in your life. I've got multiple young, single guys who do infinite banking as clients, like multiple clients.
Yep.
And they're not married. Maybe they intend to be married at some point and have kids. But for some of them, I mean, I think most of them are probably like, yeah, probably one day I'll have a family. But they're not waiting until they have a family to do this because they see the banking function. They see the important side of controlling your own capital.
That's right. You finance everything you buy, right?
Yep.
You're either paying interest or giving up interest you could have earned. So again, it goes back to Nelson, goes back to the book. It's something that you and I had to discover. Someone had to lead us to it. You had Boyd and Sheila and I had you, but you have to see it. You have to be able to see it. You have to be able to comprehend what Nelson is telling you in that 92-page simply written book.
Yeah, and you need to know what the problem is. He'll help you find the problem, but we're kind of exposing it. All of these questions are part of the problem.
The problem is the problem.
The problem is not understanding the problem.
That's right.
Yeah. All right, next one. Hey, since we're dudes, I'll say wife. If you're a woman, you can say husband. My wife will be fine. She makes plenty of money. So
good for you.
Yeah, good for you, man. You got a sugar mama? Maybe both. Maybe it's a young, successful couple like this
Dinks?
lady. Huh? Dinks, yeah. Dual income, no kids. Yeah. That's like this lady I talked to a couple of weeks ago. Her and her husband just graduated college, no debt. They worked while they were in college, paid off college as they went, which is brilliant. It's like I asked her, how many of your peers did that? And she was like, I don't know of any.
Good for her.
I'm like, I'm not surprised. So yeah, congratulations, outstanding job.
Podcast
and now they're living.
Listener.
Yeah, I think so. And now they're living at her parents' house and saving that money. But they're looking at this from the banking function. Of course, they want to have kids, and that's in the cards. But there's no reason both of them shouldn't have life insurance.
Right. The best time to get it is while you're young and throw some strategy in here. Don't forget, it's okay to throw in some term on there. You're likely going to need it because you can't afford to fully insure yourself through whole life. Throw some convertible term insurance on there, and to bridge that gap, we talked about that in a recent episode. And but start creating your banking system. Branch number 1, the founding branch of your banking system.
Absolutely. So, I mean, even if you and your spouse both make equal amount of income, don't you think you might want some time to mourn? Or maybe if you didn't have to work that job, you wouldn't, and you could just use that money to create a foundation for your spouse who just passed. I don't know, whatever you want, but wouldn't it still be nice? That's the life insurance aspect. We're completely, I mean, not to even mention the banking function, right?
Right. Yeah. No one's going to complain like, oh shucks, Grandpa Bill died and left the family $10 million. Like, oh shucks. And he was very specific on who got it. And the life insurance company is going to execute that as per his wishes, right? No one's gonna be like, oh darn, I got $1 million. Like,
yeah, do you think anybody was like, oh, what an idiot. He paid for whole life insurance. What a moron.
And that reminds me of what I wanted to say, Dave. I think a lot of people, absent the, knowing about the banking function, knowing about the problem, they don't realize that every dollar they've paid in premium will have many, it's a golden goose, right? It's going to produce so many golden eggs down the road. Sure, takes a few years to get started, but after about year 8, 9, 10, 11, it becomes this juggernaut that's just, you're going to outrun the next guy doing maybe same income, same life, whatever, is your twin brother, but you're going to outrun that twin.
Yeah.
Um,
You mentioned, Grandpa Bill dying, whatever. Wouldn't it be cool if somebody in your family, one of your father, your mother, your grandparents, great grandparents, had a policy that they left a lot of tax-free income to the next generation, and it just begat a cycle on down the line? Like at some point, like, how much do you care about legacy? Okay, you're going to retire. You don't need life insurance anymore. Your wife is going to be fine if you die. Okay, great. But are you leaving any other legacy? Maybe that's not important to some people. To me, it's very important. I want to start that for my family and be that legacy creator.
Yeah, a lot of people are worried about leaving a large amount of money, and there's things that you can do to kind of control it, not from the grave. I don't want to say control it from the grave, but there's things that you can do. There's spendthrift provisions in insurance where they don't get the lump sum. They get more like an annuity payout. There's a bunch of different death benefit options, folks. So there's one. But really what you should be passing on, and this is a complete IBC lens, but it could work. It works for anything. In this case, this is an infinite banking podcast, so we're going to talk about IBC, is the knowledge on this is how the Fugères, this is how the Befforts, this is how we do family banking.
Yeah.
And the knowledge of what we do, what we don't, and more importantly, what we don't do.
Yeah.
Right. We control the banking function. Ultimately that's the most important lesson I think we can pass on. Because if they control the banking function and they already have that mindset, Dave, they're going to know what to do. They know what the problem is. They know the solution. They've been part of the solution now as children, as young adults. They've been involved in the conversations. And then when that windfall comes, they know exactly what to do.
Yep, absolutely. You can't just leave money and no knowledge.
No, you
that's
end up
a recipe for disaster.
No question.
You end up like Justin Bieber at 19. All right. Last one. I only need life insurance on myself. My wife, since she doesn't work, she doesn't need life insurance. She doesn't produce an income. Why would she need life insurance? What do you say to that, Paul?
Yeah, well, again, from an IBC perspective, that's not the point. Maybe we've maxed you out on your human life value, and now you have additional premium you'd like to pay or whatever. Well, you can pay it on her. Now, if there's children in the home, I'd say this, what happens to your productivity when your wife or your husband, who's the homemaker, graduates unexpectedly? That is going to throw a complete wrench. Absent, maybe you have a great family support system. Most people don't.
Right.
Our parents are elderly parents, right? They're not going to be around to care for our children, right? So
and maybe even if they could, they don't want to.
They don't want to, and
they've done that
unfair.
Before.
So
yeah.
I always tell, I have a lot of clients where the wife's the homemaker or whatever, and we've had this conversation, and I say, should I take the policy on the kids so it's a little bit more efficient? I was like, well, it won't be more efficient because juvenile policies aren't. But no, you suffer tremendous loss of your spouse, non-working or working, but in this case, non-working spouse. It's tremendous loss. Your child care costs alone are going to skyrocket because guess what? She's no longer there.
Yeah.
And as someone who pays a bundle for child care every month, I can tell you it ain't cheap. Especially
if you want quality care, and your kids are probably going to need a little extra care if they just lost their mom or their dad. So, and you might want to take a lot of time off work. You might want to do some traveling, go visit family with the kids, go on vacation, whatever. It just gives you the license and the permission to mourn appropriately. And it doesn't impact at least the financial system of your life, which is, let's not minimize how important finances are in our life, right? Some people might try to, but you can't get around it. Finances are one of the most important things in your life.
I mean, it touches everything, doesn't it?
Yeah, absolutely. So, well, cool. So that was 7 either ignorant statements, myths, objections, whatever you want to call them, to whole life insurance. So I hope that helps. Those are pretty common ones that we hear. Hey, before we depart the fix here, we've got another webinar coming up, our third live webinar in April 20th, 7 p.m. Central, 8 p.m. Eastern. So we will put a link in the show notes once again. So please sign up for that. We'd love to see you guys and get some questions and feedback or stories, case studies, whatever. It's just been kind of a free for all the last two we've done. So we'll just keep them kind of on an open mic night, if you will. Yep.
Open mic. And questions ahead of time are great. We were able to address a few during that hour. So, it's a good time, good group of people, and would love to have you.
Yep. Perfect. All right. We'll see you guys there. And until next week, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.